Now, live with Greg Olson, Director of the New York State Office for the Aging.
Well, good afternoon, everybody. My name is Greg Olson, and I'm the Director of the New York State Office for Aging. It seems like a lot of the shows that we have are so timely, and I think this one really fits within that. The cost of everything is going up. You know it, and I know it. Governor Hochul and her State of the State and budget proposal have put in a lot of proposals to bring costs down. Home insurance, car insurance, utility, electric costs, and so much more. A friend of mine this morning I was talking to told me that her electric bill in January that she got this morning was over $1,100, and that's up from $780 in December. And I've seen things posted online with electric costs over $3,000 or $2,400. I think for any family, that's extraordinarily difficult and excessive. But for older adults on fixed incomes, it's catastrophic, frankly. There are more than 1.8 million older adults that own their homes in New York State, and 62% of them have no mortgages. They own them outright. So today we're going to discuss how you can use your home to help stay in your home and to afford just basic necessities or other things, whether it be, again, your utility costs, fuel costs, prescription drugs, and so on. How? Through a home equity conversion mortgage or a HECM loan. Now, you may be wary of this approach because you knew them probably in the past as a reverse mortgage. And it was kind of the wild, wild west years ago. But there's been a lot of protections put in place by the federal government to make those much more of a safe choice. So I am really excited to have my friend back again for the third time, Frank Melia, who's really an expert in home equity conversion mortgages that can kind of walk us through what they are and where to get trusted information from. So we're pulling up Frank in a second. There's a lot of things I could kind of maneuver my way around, but the HECM is not one of them. So there he is. Welcome back, Frank. It's so good to see you.
Great to see you as well, Greg.
So for those of you who are at home, everybody's journey here is going to be a little bit different. So what Frank is going to do is going to kind of walk through some of the basics so that you understand what these are, how they work, and how they might be a beneficial option for you, especially when we're in this, really difficult time and people just basically affordability issues that are really difficult. So if you have any questions, as always, feel free to put them in the chat and we'll get to them after we walk through some of these things. Frank, let's just start with some terminology so people understand. I think people might have heard of reverse mortgages or HECMs, but really don't know what they are. So tell me what a home equity conversion mortgage is.
Great to be with you again, Greg. And I'm going to answer these questions. And if there are any questions, please shoot them in so we can address anything that any of your viewers are going through personally. A home equity conversion mortgage, commonly known as a HECM, is a federal insured reverse mortgage. It allows homeowners age 62 and older to tap into the equity in their home. They can convert a portion of that home equity into tax-free cash that they can withdraw from their property without having to sell their home, or they don't have to make any regular monthly mortgage payments. Unlike a traditional mortgage, where your loan balance goes down over time because you pay it off, the HECM balance increases gradually as more funds are accessed. Now, you can make payments. There's no penalties, but most people use it for cash flow. The loan is also non-recourse, meaning you and your heirs will never owe more than the value of your home.
Yeah, I think that's important. Like, people don't realize that probably their biggest asset is their home. And I know people are sitting on trillions of dollars of home equity that they could be using. We know that almost everybody wants to remain in their homes and communities. It's where they grew up. That's where they raised their families. and having this asset available to them if they need it, especially in these really difficult times, is an option that a lot of people just don't utilize, which is why it's so great, again, for the third time to have you on here to walk through it, because I think that there's going to be a lot more interest today than maybe there was a year ago. How can a HECM loan, Frank, help an individual or a family?
HECM is a planning tool. It's not just a loan. And when it's used correctly, it can do numerous things that can help you age safely in your home. It'll eliminate any existing mortgage payment. So if you have a mortgage on the house now, a home equity line of credit, which we get a lot of, or a first mortgage or a combination, those will be paid off. So right there, cash flow will increase. You'll also create a standby line of credit. That's basically what a home equity conversion mortgage is. It's a line of credit that you can access when you need it, pay bills, do home improvements, and it grows over time. You can also use it, which we find a lot lately, to reduce portfolio withdrawals, meaning you have IRAs, you have pensions, you have different things that you go to when you have to pay your taxes, or you'll go to those investment accounts when you have to pay bills. This can reduce those withdrawals and help those investments actually last longer for you and your heirs. We've had families delay Social Security, meaning that when they were thinking of taking Social Security, they drew from the line of credit through the home equity conversion mortgage. And then
we lost Frank there for a second. Hey, Alex, can you pull up a couple of the slides that because I think give folks, while we're getting Frank back, just an opportunity to look at all the various things. There we go. So I'm sorry, Frank, we lost you there for a minute. So you were talking about like IRAs, things of that nature, people delaying Social Security, and then we lost you. Go ahead.
I see with the Social Security, not as much, but some people will say if they're going to take Social Security at a certain age, they'll draw money from the line of credit and then get a larger benefit later on through Social Security. The number one reason, or the top concerns or questions we get is to fund home improvements, to fund healthcare, home healthcare aids, out-of-pocket expenses that Medicaid might not take or pick up, or any type of long-term needs. Those are the main reasons why people will usually look into this program. It also supports aging in place, which I've always said over the years. You don't have to downsize. Some people will say, well, I might have to sell my home. But if you look into the line of credit and it supports your lifestyle and allows you to age safely in your home, you can definitely delay maybe downsizing or not downsize at all. We work alongside with a lot of financial advisors and elder law attorneys as well throughout the state. So whenever you implement these strategies, always talk to these professionals, because sometimes it'll also come into play with your estate planning, any Medicaid planning, or any retirement planning. And remember, it's really not a last resort. It used to be a last resort loan years ago, but now if you're proactive and you know how the loan works, it could definitely help you in your retirement.
Yeah, and I think the timing of this is so important. One of the things I love about the way you approach this issue, Frank, is you ask people what it is that they want, what their goals are, so that they can do those types of things. Like you could do a minor home modification to make your home safer, as you were talking about, or pay for community-based long-term care. Or now we're in this environment where, like I said in the beginning, people are paying, thousands of dollars every month just for their electric bills. I mean, it's a crazy time, and this asset is so important. One of the questions that I get a lot, and I'm sure you do too, is if I entered into a HECM loan, am I forced to leave my home?
As long as you meet the basic requirements and obligations of the loan, you can spend the rest of your life in the property. The obligations are very straightforward. They go over that during a phone counseling call that's mandated before you can even look into these loans. You have to live in the home as a primary residence. Now, you can own multiple properties. You can have a house, that you live in. You can have a summer home. You can have a lake home. It's where you reside, where you sleep. So that's as long as you reside in the home as a primary residence. And as long as you keep your property taxes and your homeowner's insurance and any other HOA fees current. Now, the program allows you to draw money from the line of credit to obviously pay those. And there's even other advantages now to this program that you can have the line of credit just pay those expenses automatically. So your taxes would be paid, your insurance would be paid, and your HOAs would be paid. And the last condition is just as long as you keep the home in reasonable condition. Now, people always ask me, what does reasonable mean? The house has to be habitable, livable. We're not looking for improvements. No one has to have a perfect home, but everything has to work. Gas, electric, heat. You know, you have to have a property that's livable and it's comfortable and it's safe for you to age in. There's no maturity date. There's no balloon payments on these loans, and there's no requirement to move. The only thing that does happen, as we mentioned earlier, is the more you access from the line of credit, the larger your loan balance will get, but they'll get a monthly statement every month in the mail. So every homeowner should know exactly where their balance is.
Yeah, and you had mentioned while you were talking just a couple of different ways that somebody could accept funding. Can you walk through that again? Like, is it a check? Can you use credit, a pay as you go? Just kind of go through that again.
Perfect. There's a lot of flexibility with the home equity conversion mortgage, and the funding structure can be structured several different ways. One is a lump sum. I don't see as many people take a lump sum because we always go over with what are your needs? What are you looking to accomplish? But there is a lump sum available. It's a fixed rate option, which is a little bit higher than the adjustable rate right now, but you can take all the money up front. The only families that I find would look into that option is if they have a large mortgage on the house. So if they qualified for, let's say, $300,000 in the benefit, and they owed $300,000 to the bank that they have now, maybe that lump sum would make sense because we have to pay off the existing mortgage. The second option is a line of credit, which 99% of families across the country utilize. And the line of credit grows over time. To keep it real simple, whatever you haven't tapped into yet. So let's just keep the math simple. If you have a $100,000 line of credit, but you've only used $20,000, the $80,000 that's just sitting there waiting for you to access grows each year by the interest rate that you're paying on the balance. So it's a great way to just stretch out these funds so you can age safely in the home. It's also excellent for long-term care planning and have liquidity. The line of credit I find is the best option usually just because you're not accruing interest on such a large sum. You have access to the line of credit 24/7. You can link it to your checking account or to your trust checking account if your home's in a trust. And you get an 800 number, you call up, and you could draw money when you need it. The third option is a monthly payment, which we call tenure or term. Some people, I've just spoke to a couple of individuals this week in New York State that wanted to pay off their home equity line of credit, and then they wanted a specific amount every month on the 15th. $3,500 one woman needed $1,400. So you can also structure the loan that way, so you'll get a monthly payment or a monthly tenure. But remember, if you go with that option, it's a line of credit. So you can change it at any time. You're not locked into taking that certain amount. If life changes in the future, or if your expenses change, especially if you pay down high credit card debt, you can always change that feature. And then the last strategy is just a combination of all of the above, meaning you take a line of credit like we just discussed, and then you can call us up in the future and say, sometimes I'll have a husband and wife take out the line of credit, and then they'll lose their spouse, and they lose their pension, or they get the higher of the two Social Security checks. So then you can call us in the future and just say, put me on a structured plan, a term plan that gives me X amount every month on a specific date. When you do it, when you look at the planning, and like I said, you involve your financial advisor, you involve your attorney, and you work with a competent individual in the mortgage industry that does a lot of these loans, you'll be able to structure the loan appropriately so you'll get the best out of the loan program.
Yeah, and I love the flexibility as you go through all these different options, the ability to change, but to have, again, based on what somebody might need is going to be different than what somebody else needs, and that flexibility. So now that Frank's kind of giving you the basics, we've got a 2-minute video I want you to see that talks a little bit more details about what a HECM loan is. So check this out.
What is a reverse mortgage? A reverse mortgage lets you convert part of your home's equity into cash without selling the house or making monthly mortgage payments. And you can live in the home for as long as you meet the loan obligations. Instead of putting money into a house by making monthly payments on a traditional mortgage, you can take money out of your home's equity. That's why it's called a reverse mortgage. Similar to a HELOC or cash-out refinance, you can choose a lump sum disbursement, monthly payments, or establish a line of credit or combination of these. For those with higher home values, special products exist to maximize your benefits, up to $4 million. To qualify, you typically need to be 62 years old or older, own the home, live in it as your primary residence, and undergo a financial evaluation. You also need to pay property taxes and homeowners insurance and maintain the property, just like with a traditional mortgage. Reverse mortgages have evolved over the past decade, so it's important to know the bank does not own your home. You maintain ownership, and if the loan obligations are met, the bank can't take possession of the house. Your heirs never inherit the debt. They may keep the house and pay off the loan, or sell the home and take the profits. But they're not personally responsible for debt if the house depreciates in value. Reverse mortgages can often improve cash flow at all income levels, including for affluent individuals. With a reverse mortgage, you are in charge. In most cases, you're free to spend the money however you choose, to cover medical and long-term care expenses, pay off an existing mortgage, fund grandchildren's education, or travel.
That's great. I love it. Frank, I'm going to ask you about protections for people coming up here, but this is such an individualized decision, and I know it's hard to generalize who might be right, who might not be, which is why folks need to reach out to people like yourselves or other professionals. But generally speaking, in what cases is a HECM loan not generally advisable for somebody?
Well, it's a good question. The way I look at it is if it's a good match. You know what I mean? If it matches what they're looking to accomplish, and if it doesn't match what they're looking to accomplish, then obviously it's not a good fit for them. A HECM is really just housing wealth, looking at the housing wealth and turning it into a liquid asset. What I've come across over the 25 years helping families in New York with these loans is a lot of retirees will come to us and say they're house rich, cash poor. We hear that a lot. So if your biggest asset is the house, and maybe you've exhausted your retirement accounts or you've exhausted all your other savings, it could be a good match for you and your family. Homeowners that traditionally or carrying a mortgage into their retirement years may be a good fit and a good match for this program. Because, if most of us, not all of us, but when sometimes, when families or husbands and wives or individuals retire, their income changes. So if their income changes and they're still carrying that traditional mortgage on their property, this would pay off that mortgage and obviously increase cash flow immediately. Clients that want to maybe eliminate or reduce withdrawals from their IRAs, like we mentioned previously. People have to take required minimum distributions from their IRAs and their qualified funds. But some people rely on those funds, before they hit that RMD age, where they just access their 401k or they access their IRA. I was on the phone call this morning with a woman that's using her IRA, and her biggest concern was that she's going to run out of the IRA assets. So we have to look at the home equity as well as their retirement accounts and work it into their retirement plan. Some families look into just sequence of return risk, not to get too complicated in it, but when they talk to their financial advisors may advise them to take less from their IRAs when the stock market's not doing so well. Take more from their IRA or their retirement accounts when their retirement account in the stock market is doing better. So this is just a way of maybe structuring where they take their cash flow from, regarding how their assets are performing. Homeowners always look to just age in place. I speak to hundreds of homeowners each month around the state as well as the country. And not once have I heard someone that says, I'm planning on going into, and I want to go into a care facility.
Right.
Now, people do obviously go into care facilities or they need home health care. But if it's a good match and keeps them in their home and keeps them in their home safely, it's a great match. Widows and widowers, we get a lot of. that really just, they have to make an adjustment to now being on one income, or they lost their husband's or they lost their wife's pension. So now you're living in New York State. You're used to having two income sources, or maybe three or four income sources between Social Security and pensions. And now you have one income source or two income sources. So that makes it a great match. Clients with large 401ks and large IRAs also don't like to pay income taxes sometimes. So we always get the question, through their accountants, and when we're talking with their trusted professionals and the homeowners, that they, every time they take $1 out of their IRA, their marginal tax bracket could lose 30 cents or 35 cents between the state and the government. And those IRAs are now, are allowed to be stretched to the next generation. So, when you speak to your financial advisor and you speak to your tax professionals, sometimes that's a strategy which makes this a great match. And just liquidity for home health care. I keep coming back to that, Greg, because probably 8 out of 10 or 7 out of 10 people that I speak to on a daily basis usually are looking to cover something through healthcare or just longevity planning, to stay in their home, have control, have flexibility, and have different options.
I think that's going to be so much more important with the implementation of HR1 and the almost $1 trillion that they take out of Medicaid for the next 10 years. So those options, and something you were mentioning really struck me. People that have pensions and IRAs, and while a good proportion of New Yorkers do, a very large proportion don't. And so again, having this huge asset sitting there and not working for the person to be able to, again, meet whatever their needs are. And, as you mentioned, I hear the same thing. Everybody wants to age in their community. It may not be the same house, it might be, but, the preference is not to go to assisted living or an out program or a nursing home. So what is the difference between a HECM loan versus other reverse mortgages? And why should an older adult consider a HECM loan first?
Not all reverse mortgages are, like I said, created equal. What I mean by that is the home equity conversion mortgage, is federally insured through HUD and through FHA. And it has a lot of safeguards involved, which protect our aging population here in New York State. The main difference between a HECM, a home equity conversion mortgage that's federally insured, and some of these proprietary reverse mortgages, you have federal insurance, you have oversight by HUD, which really is there to protect all of our aging individuals here in the state. Makes it a non-recourse loan, which gives you protection. Basically, you and your heirs will never owe more than the home's value. So regardless of how the loan balance increases, if you take all of the funds or if you need all of those funds, regardless of when the loan gets paid back, you'll never owe more than the market value. So they can't go after personal assets. It's really just the collateral, which is your home. There's mandatory counseling. This started about 15 years ago. And personally, I think this is the best feature or the best protection that's out there for our homeowners. It's a simple phone call. There are some local places that'll do it face-to-face, but they're not as readily available as they used to be, in my opinion. So there's HUD agencies. So when a specific homeowner says, I want to move forward with this loan, we give them a list of all the agencies that are in the country and the local agencies in their county, and they set up a quick phone call. The purpose of the phone call is the government wants to make sure that you're not under duress. You're not being forced to do this. You're not being told to do this by someone that may not have your best interests. And the phone call, I had a phone call this morning with a gentleman, and he was nervous about the call because he thought he was going to be tested and he had to pass or fail. It's not a pass-fail type of phone call. It's really just for the HUD counselor to observe the individuals that are going to take out the loan, see if they're under duress, like I said, or if they're stressed out about anything. And they go over the basics of the loan program like your banker would or your mortgage broker. But they're really just to make sure that you understand what you're doing and that it fits into what your financial plan is. There's standardized consumer protections with a home equity conversion mortgage. No bank or lender should ask you for money up front. Fees are disclosed. Fees are standardized. Every fee associated with this loan is standardized by the government. So even lenders can't change it. Disclosures have to be given to every homeowner when they do the phone call and before they apply for the loan. And the loan structures are regulated. Like we went over previously, they'll decide how they're going to take the assets, but it's regulated where, you can take a certain amount if it's a lump sum. The rates are market rates, but the government does look at interest rates to see where rates are. Now, by contrast to what we just discussed with the home equity conversion mortgage, there's proprietary reverse mortgages. I have families that sometimes look into the proprietary reverse mortgage for one reason. It goes for higher lending limits. Right now in New York State and in our part of the country, the maximum home value that you can use for a home equity conversion mortgage is $1,250,000 approximately. So that means if your home is worth more than that, you're not going to be able to access that equity. The proprietary reverse mortgage goes up to $4 million. So for any of the listeners or anyone in the state that have higher priced homes, maybe the proprietary mortgage would be a good fit. They vary widely by lender. They vary widely by who you're speaking to, whether they be a mortgage broker or a mortgage banker. They don't have some of the protections. They do have the mandatory phone counseling call, these other reverse mortgage products, but they're not insured by HUD. They're not non-recourse, so they could go after your personal assets possibly. And they work with certain niches. I do know of some states, I'm not sure if New York State has it, but some states even have, and some local counties have single purpose reverse mortgages, meaning if a homeowner needs certain improvements to their property, the state might have funds to give them to the homeowner, and there's no required monthly payment. So theoretically, it's a reverse mortgage, but most states call them single purpose reverse mortgages. Throughout the industry and throughout all the homeowners that we speak through, whether through webinars, seminars, or speaking publicly, the home equity conversion mortgage is the gold standard. It's more safe, it's more consistent with its regulations, and it's got guardrails built into it. So before a homeowner should move forward, and I say this to everyone I speak to, before I even feel comfortable telling you to move forward, you have to understand everything about the loan program. It's not that much information if this person you're dealing with keeps it simple. And with those guardrails, it makes it a good choice. And that's what makes these programs better choices than maybe other options that are out there.
Yeah, and I think I'm so glad you went through all those protections that went into place 15 years ago, because there was a long history of really bad outcomes from the reverse mortgage market prior to that. And you've got, you flip your TV on in the afternoon and Tom Selleck is selling reverse mortgages, and the trusted source is really what you're talking about, the certified counselors. I love the phone call for the visual. We do a lot of work here at the State Office for Aging and with our partners in the community to try to mitigate and combat scams and fraud. And so all those guardrails are really, really important. Frank, if somebody wanted to start this process, where would they go? I mean, certainly folks could call you and others. And how long does it take from beginning until the cash starts flowing, depending on which way the individual wants it to?
Have an initial conversation and be educated by a local professional. Obviously, we do this on a daily basis, but work with an individual that is in the reverse mortgage industry. Simply what I mean by that is someone that does them regularly. So you have an initial conversation. You'll see how much you can qualify for. So you know that the amount that you would qualify for with the line of credit or the lump sum satisfies what your family's goals are and what your goals are to stay in the community. You'll do a preliminary financial review. That's what we do. We just look at all the assets that are accessible to the family. If there's family members that can help out. So we usually sometimes do a Zoom call, or, you should have a conference call with whoever you're working with, and really get an idea of anyone in your family that would be involved in this process, whether it be your children, your priest, your rabbi, your spouse, your partner, or just a trusted friend. The HUD-approved counseling session, like I said earlier, is the most important thing. I love that feature because, you're doing it with an independent individual. We're not on the call. The lender's not on the call. You can have anybody you want on the call, but they're just going to ask who those individuals are. So it can't be a financial planner or an attorney or a banker because they have a vested interest in you maybe taking that loan out. You'll do a formal application. So after that conference call, the counseling call, you work with a local lender, or you can work with any local lender that you work with that offers these FHA, home equity conversion mortgages, and you do a formal application. Now, remember, anytime during this process, you could just stop the presses. You do the counseling call and say, you know what, it's not for me. End of story. You don't have to move forward. You don't owe anybody anything. The process would stop. You could do the formal application and then still decide that you don't want to move forward with the application. So all the safeguards are involved. After the application, the local lender that you're working with does typical underwriting, simply meaning we're going to ask you for your income documents, how you derive your income, your ID to show your age, that you have homeowners insurance on the property. Then you have any other maybe monthly HOA fees or flood insurance or other types of insurance that are attached to the property. And a full appraisal will be done. It's a full interior and exterior appraisal. And it's a good feature because some people say, why can't it be a drive-by? I went to a bank once and they did a home equity loan of credit and they didn't even come to my house and appraise it. Or they did what's called a drive-by, meaning someone just drives by the home and takes a picture. Why I love the feature of an interior and exterior is because this is for our aging population. The average age, it's 62 to qualify, but my team and my bank's average age that does this loan is 83. And sometimes families scattered all around the country. So when you do an interior and exterior appraisal, it really gives the bank a good idea if there's anything that needs to be addressed. And the appraisal will point that in the report, meaning, put a handrail on that staircase. Right. There's no smoke detectors. There's no carbon dioxide or monoxide detectors in the home. So a full appraisal will be done, underwriting, and then you'll get a closing date. This whole process can take anywhere from 30 to 60 days. Now, remember, even up until the closing date or at the closing table, every homeowner has the right to say, I don't want to move forward. So if you decided to do that, just know you're not in a contract, more or less. You're not saying to whoever you're working with when you first meet them and you sign the application, you're not signing a contract or a document that says, you have to close this loan. Now, most people do. When I sit down with families, I want everyone involved in the process, the kids, whoever is going to influence or help make that decision for the borrowers. I want to speak to them. I want them on a conference call so we can answer all of their questions. Because I find from experience, it's a child or a partner or a neighbor or a friend that pops into the equation, on the 23rd hour and puts that, not their 2 cents, but makes comments that sometimes changes, the person's perception of the loan. So when you have all these safeguards involved, the counseling call and all the different safeguards, from my experience, the process goes smoothly. It's just going to vary on if something surfaces with the appraisal and they have to install some items. Like right now, we have some clients in the upper, above the capital region in New York State, that, the appraiser couldn't even do some of the report because of the ice and because of the snow that's built up. So, those loans could take a little bit longer just because, if they have to do some work. We have a woman up in the Lake Placid area that has to do some exterior handrails, and no one's really available right now to do that because it's minus, 10 degrees on some days, and there's too much snow on the property. So as long as you work with someone that defines the timeline and easily accessible and communicates with you, the process should go smooth.
Yeah, and I tell you what, I love having you on because you can explain something really complicated very easy. We wanted to make sure that people understood, what this is. You laid out so many protections that I think people just don't know exist, or to the breadth that they do to make sure that the decision's right, that people aren't getting scammed or frauded, that the decisions are based on what an individual needs. I love the interior assessment, because you're right. A simple grab bar or a railing or some other small changes can be the difference between falling, breaking a hip, and winding up in a nursing home the rest of your life, or being safe at home. So, you talked a lot about the protections, and I am 100% behind protection, protection, protection. Are there other things like accreditations or things that folks should look for when they're starting to do the research on whether or not that this is a good option that they want to pursue?
Start locally, but look for individual. We're called loan officers or loan originators that work at either credit unions, local community banks, or big federal banks or mortgage bankers. Now, not every institution that I just mentioned offers these programs, because you have to be FHA licensed and you have to be trained in this program. But start locally or work with someone that has the experience. What I mean is, not someone that does a few. I got a call about a month ago from a very nice woman that said, her friend's son does reverse mortgages, and she was speaking to him. And then she found me through one of her financial planners, and I was basically not correcting, I don't want to use that terminology, but I was really educating that loan officer on how the program works with the woman, just because that wasn't their specialty.
Yeah.
So when you work with someone that knows the program very well, and understands the nuances and what to expect and what to anticipate, because remember, like I said, the average age that we work with is 83 years old. Now I'm 58, so I joke, when you hit 50, things change, and then 60, 70, 80. So as we age, things change, memory changes, how we interact with people changes. So when you work with someone that has maybe a little bit more experience or some accreditations, I have a certified mortgage planning designation for the past 18 years, which just means I do continuing education on these programs annually, and we stay up to date with all the programs. The communication to the homeowner is better, it's more clear, and it can help the process be less stressful for the homeowner. Because I had a woman say this the other day to me, which was on point. She's like, Frank, I never thought when I hit 85, I would say to someone, I want to take out a new mortgage. And no one even thinks that they can take out a mortgage sometimes when they're 85, because we're historically, programmed to know there's 30-year mortgages. How can an 85-year-old take out a 30-year mortgage? This loan program doesn't have a term. It's just as long as you live in the property. So, work with someone that has some accreditation or just does continuing education on these programs. Speak to your financial advisors, speak to your CPAs, speak to your elder court attorneys. I work with all three. We're referral based. So we work with all those financial advisors, CPAs, accountants, and elder court attorneys throughout the state. So we usually have them involved, or they're introducing us to some of your listeners and the homeowners. And involve your family, but I say this cautiously, involve your family that you want to involve. I'm not here saying don't involve all your family members, but if it's up to you and you want your son or your daughter or whoever in your family, you want to lean on, you can have them all involved, but leaning on family also creates transparency. So your heirs, which are usually your children or your friends or whoever you're leaving your estate to, understand what you're doing, so they're not surprised, or if something happens, if God forbid something happens to you unexpected and you're no longer here, your family and loved ones would know what you did and what type of loan you might have had on the home. And we share our information with the family members. And I always tell every borrower, give your son, your daughter, whoever you want, or your heirs, give them my cell phone, give them my name, give them my number. Because if you're ever incapacitated or you can't represent yourself or you can't let them know what's going on, at least they can lean on a trusted professional, to explain what type of loan program you might have had.
Yeah, I think that's good advice. I always, again, why I like the way you approach things is sometimes families can muck up the works, right? And you always approach it from the client first. So I think, consulting family is great and should be done, but not at the expense of what the older individual who's actually applying for the loan wants. Let me ask you this. Here's the $1 million question, Frank. So let's say my mom has a chronic, illness. I want to get home care for her. money's tight. I know she's got assets. Can I do this on her behalf or do it without her knowledge?
Greg, that is one of the most important and sensitive questions I get all the time. In most cases, you have to have legal capacity and mental capacity to move forward with these loans. But if you, in New York State, as well as other states, and depending upon the lender that you work with, which should be all lenders that offer these programs, a power of attorney or a guardianship should suffice. The process is it's not cumbersome, but it really just depends on when those documents, when the power of attorney was executed and or when the guardianship was appointed. The guardianship courts in New York State, I work with a lot of the courts and I know some of the judges, so I know that process. That's not really, no one's going to question a court-appointed guardian, and the guardian can move forward for the person with that chronic illness. But there are certain provisions in that guardianship that the home equity conversion mortgage guidelines need to make sure are in those guardianships. I've seen guardianships over the years that didn't have that language, and other lenders couldn't move the file forward and couldn't get the guardianship approved. So like I said previously, when you work with someone that's in this industry, they'll know how to hopefully navigate the guardianships. The power of attorney, it's usually a durable power of attorney in the state of New York. It doesn't make a difference when it was drafted or when it was executed, as long as there are certain provisions in that durable power of attorney that allow you as the agent for the person with the chronic illness to do certain transactions, which is real estate transactions, sign on their behalf, and most of them do satisfy that. The home equity conversion mortgage guidelines do ask, though, for an independent third party. Now, it can't be the attorney that drafted the power of attorney, can't be your friend or your family member. It's usually a medical professional. We've expanded our list. It could be an LPN, a PA, someone in the medical profession that has seen that person in the past. They would just need to give us a correspondence. Usually it's a letter stating that, when Mary or John signed that power of attorney, they were okay to handle their financial affairs. So as long as we, dot all the I's, cross the T's, and get an acknowledgement of power of attorney, and I see more of that today, I believe it's not because people wait to do this loan. It's just that people have done their planning. They've sat down with their elder law attorney, or they sat down with their financial advisor. And I recommend all people do it. I'm in that age bracket. I'm in my 50s. So, me and my wife look at it now. You should maybe do a will, a healthcare proxy, and a power of attorney. Because you never know if something's going to incapacitate you. Someone can make your healthcare decisions as well as sign things of this, like a home equity conversion mortgage application. So work with the professionals. Get your family involved to the extent, like you stated. And if someone does have a chronic illness, and we come across more of them today over the years that we've been doing this, it should go smooth as long as you're working with an individual and a lending institution that knows how to navigate those documents.
Awesome. Thanks, Frank. We're going to take a quick break before we come back to audience questions, because I know there's going to be some. So coming up next month, March is National Nutrition Month. We do a lot of things for March for Meals to really highlight the nutrition program in New York State, which we administer through our county partners. We administer the largest nutrition program in the country. We're going to be in Saratoga, New York as part of this year's efforts, and we're actually going to do our first Live with Greg show on location. So it's going to be exciting. Hopefully it works out well, but we want you to take a look at this. I love that. So that was Life Path in Albany, New York, and that's a real shot at what one of our programs looks like that prepares meals. And I was thinking as I was watching that, there are new guidelines that are going into effect on work requirements for SNAP participants between the ages of 60 and 64. And one of the things that is countable to meet the workforce requirements is volunteering. And we could always use more volunteers, whether it's through our nutrition program, transportation, health insurance counseling, long-term care ombudsman, and so on. That's certainly an option, and we'll be getting more information about that. So let's get to some audience questions here, because it's not often we have such an incredible, articulate expert on something that I think is incredibly timely given where we are. So Beth Stranges, Chemung County Office for Aging Director, who is always the first one in the chat and watches every single show. So I thank you, Beth. Is there interest accrued on this loan? And if so, when is the payment due?
That's a good question. Interest does accrue on whatever the loan balance is from the closing. So if you draw money at the closing, that would be your loan balance plus finance closing costs. So whatever your loan balance is at the closing when you start the loan, whatever the annual interest rate is at the time that you close on the loan would start to accrue on that loan balance. Now, there's no required monthly payment, but it will reflect the interest for the month. It'll be broken down monthly on an annual rate on your monthly statement. So everyone that takes out a home equity conversion mortgage gets a monthly mortgage statement mailed to their home once a month. I like to sometimes reference it like a credit card statement. You'll see the loan balance on one side of the statement, and then you'll see like the line of credit that's available on the other side. No interest is accruing on what you have not accessed. So it's really on what you've taken so far and what the loan balance is. And interest does accrue on these loans until it's paid off. So even if a homeowner passes away and it's left to the heirs, interest will still accrue on the loan until the heirs address. Most heirs, from my experience, sell the home. They don't have to. They can take out their own mortgage and pay off their parents' balance. But interest does accrue on the loan balance that you've accessed until the loan is paid off.
Thank you, Beth. And I got to tell you, I'd be offended if you didn't ask a question, because you always do. We have more questions from Beth. How can caregivers help their loved one think through this decision? Can you share a real world example of someone who used a HECM successfully to age in place? I know that you can.
How can a caregiver help?
How can a caregiver help their loved one with the decision making, or to talk about it or raise it? And then a real world example. I'm sure you have many.
Most of the children are caregivers, from my experience, including my wife, who's been a caregiver for her mom and now for her dad. So get your children involved, whoever those caregivers are. Now, don't get me wrong. If it's a home health aide, nothing against home health care aides. I work with a lot of people in the elder care industries. But as long as you know the individual, and it's someone that knows your lifestyle, knows your expenses, or gets up to date on your expenses, what the upkeep is for the property, what your lifestyle demands on a monthly basis, with cash flow. Like I mentioned earlier, the best feature that I love is the counseling phone call or the counseling appointment face-to-face. You can bring your caregivers to that appointment. Like I said, the individual that's conducting the phone call or the appointment will just ask, who is this individual? They want to just establish who that individual is to you. There's no limits on who could be on the call or any caregiver, but they just want to make sure that, like I said, they have your best interest in mind. They won't ask them any questions, but they can help you in the decision-making process. Regarding case studies, as I call them, because I do a lot of continuing education for professionals, there's numerous ways that individuals use this loan program. On the caregiver area, which was brought up, that's probably, like I said, home health care and home improvements are the top two reasons why individuals look at this program. And when it comes to caregiving, there's no limitations on what you can do with this, obviously, this program. We had a family recently where the father or the spouse was in a care facility. They weren't sure if he was coming home. He fell down, broke his hip, had some mobility issues, was in rehab, was in the hospital, then was in rehab. Now he's in like a long-term care facility. But their goal is to get him back home. So then we had the wife, the spouse, in the home. And everyone, not to get into specifics, but when you're in a care facility, you know, you can qualify for Medicaid, or the Social Security checks goes to the facility, you know, to pay for the facility. So there was a cash flow issue with this family. I've been speaking to the adult children, you know, and they were caregivers for the mom. They're helping the mom at home, but she has more mobility and she can function better. She's starting to have some memory issues, where the father who's in the care facility is really more of a mobility issue. So we're working through that case right now, where we're exploring the home equity conversion mortgage. The children don't have the ability to help the parents due to their own lifestyle and their own, you know, income. So we're looking at the home equity conversion mortgage, which we've done numerous times in the past with this type of scenario, to keep mom safe in the home as her aging increases or her memory may start to get affected, you know, just because of aging in place, and try to get dad home. They think he can. They spoke to the doctor recently, and as long as he works, he does his rehab and he builds up his lower body strength, they'll be able to get him home. And then last night I did a conference call with one of the daughters, and their concern was also to, you know, make the home more accessible for dad. You know, he may be wheelchair bound. He loves to cook, as she put it, and the kitchen is not accessible, and it's not really in a proper layout for someone that might be in a wheelchair. So we're looking at the line of credit, keep mom in the home, get the husband back to be with his wife, and to draw money when needed. There are hundreds of stories I can tell, but obviously with time constraints, but that's one. That's a typical situation that we come across.
And that's a great story because it meets so many different needs. You know, I wouldn't say it's outside the box, but it's not like, well, we're paying for a home health aid. No, there's a whole bunch of options based on what the person or persons need. Alex, you can put that one back up. I think it was, there you go. What's the difference between a personal loan and the HECM program?
I've had individuals recently that contacted us, and I had a woman up in the capital region actually that her boiler went. You know, the heating system was this before the snowstorm, thank God. So she only needed a small amount of money. I'm only mentioning this quickly because that's when I find a personal loan might actually work for an individual, because there's no closing costs on some of the personal loans, and it's a small amount that was needed. But the main difference between a personal loan and a home equity conversion mortgage loan, I'll go through them quickly. With a personal loan, it's income driven and credit driven, and repayment begins soon as you get the money. It's usually non-recourse, and it's not against the property. So banks, financial institutions, some online institutions do personal loans. They're going to ask you for your income, your credit, and they're not going to attach it as a lien to the property, which could work because it's not encumbering the real estate. But with a home equity conversion mortgage, it's not as income driven. We do have to make sure you have income to pay the utilities and the upkeep of the property. But since there's no repayment and you have an option to make a payment, it's not as credit driven. We do look at credit, but it's not a credit score driven. We just want to make sure there's no very derogatory credit. And if there is, we get explanations. There's monthly payments on a personal loan where there's no monthly repayment, which is an option with the reverse mortgage. I already mentioned it's secured. Like I said, it's unsecured personal loan where a home equity conversion mortgage is secured by the real estate. Also the purpose of the loan. Personal loans are usually to a certain limit or for a specific purpose. I used a personal loan maybe 15 years ago when I was doing a pool in my backyard. I had money tied up in different avenues, so I wanted to get a personal loan. And they did have a questionnaire which they made me and my wife fill out, and they want to know what you're using the money for. So they're specific on personal loans. You could check off a box. I'm not sure how they verify it, but they do ask you what the money's being used for. And there are certain things that you can't use a personal loan for. Where with a home equity conversion mortgage, there's no limits. I had a woman once, she had a very large line of credit, so she took like 10 family members on a cruise. I don't advise that sometimes because you're spending a lot of money out of the line of credit, but you can use the money for anything. No loan officer, no lending institution can tell you that you're limited on what you can do with those funds. Risk of foreclosure. A personal loan, if it's attached to the property, some are, like I've said, but most aren't. So if you miss payments or if you go into default, you can go into foreclosure if it's attached to the property. With a reverse mortgage, we have not seen many, if any, defaults since they changed all these regulations in 2015 and 2018. The only way you can get into trouble with the home equity conversion mortgage is if you stop paying the county real estate taxes. But usually the line of credit's there to pay those taxes. So the default rate on these home equity conversion mortgages is not at zero, but it's very, there's not many reasons why you can lose the property to a home equity conversion mortgage. So just to summarize, you have payments with a personal loan and much higher interest rates. I looked at some personal loans for a client recently, and they're between 8 and 9%. Where right now some of the interest rates on these home equity conversion mortgages are at 6% or even below 6%.
That's great.
And you don't have to encumber yourself with monthly payments. Those are the basic differences.
Yeah, Frank, I so appreciate you. We're just about out of time, but I think the way that you explain this, again, the options that are available for families to think about, the flexibility within these arrangements, and most important, or equally as important for me anyway, is the protections that are available. So the takeaways for folks out there are, number one, this is an option to help you stay at home. Frank gave a variety of examples. Number two, make sure it's a HECM loan that is covered by the federal government, so it has all of these protections in it. Number three, reach out to somebody like Frank. Frank is a New Yorker. He's situated in Long Island, but as you mentioned, he was mentioning places that are not on Long Island and covers all of New York State. But having that professional like him that does this for a living for over 25 years is really, really important. So Frank, thanks again. I think we're going to have you back in November, which is National Caregivers Month, because, there's two angles here. I think Beth's question was absolutely right. How would a family member who maybe now recognizes that this could be valuable start the conversation with an older adult who may not know that this type of asset that they have can really assist them? So I think we'll do that. And time to, I think, tee up our statewide training again. So we'll have you back for both of those. So join us for our next show, which will have Jim Eisenberg. I thought this was the most amazing thing. He has created an organization called Grandpas United, which is a mentorship organization developed by himself that has more than 60 grandfathers that are mentoring young men in school and young men in general. I just thought it was amazing. We honored him at last year's Older New Yorkers Day ceremony, and I just think it's amazing. I really think it's amazing. So again, Frank, thank you so much for joining us today, sharing your passion, expertise. Again, to my communications team that makes this production incredible, Alex, Darren, Roger, thank you. And for all of you that tuned in, thank you as well. Please share this with any and everybody that you know so we can get the word out. This is a great, possibility for people to help themselves stay in their homes at a difficult time when affordability is an issue. Thanks for joining us. We'll see you next time.
Live with Greg is a production of the New York State Office for the Aging Communications Bureau. Please join us next time.